What's going on, everybody? Welcome, my financial family, to the halftime update 2024. Happy Independence Day. Happy 4th of July to those of you living in the U.S. I'm literally recording this at 5:32 p.m. to start on the 3rd, so Wednesday the 3rd. I did start putting together charts on Monday. I had every intention of getting this finished, recorded, and sent out on Monday or Tuesday, but things just got too crazy. We've been really busy at the office. Having another awesome record year, so super excited about that. However, that does mean it is really busy, so hard to sometimes get all this stuff out, especially really elaborate things. So with that being said, speaking of elaborate, we have a lot to talk about, and I don't have a whole lot of time. So I'm going to jump right in here and first and foremost show you how you can get a hold of me if you want to get a hold of me. Just a couple quick things here. You can reach out to us at info@libertaswealth.com. You can scan the QR code on your screen on the left there. That will take you to basically a link or a quiz, some questionnaire, if you will, to ask some questions and see whether or not we are a good fit in case you want to get a second opinion on your financial plan, retirement plan, or portfolio, or both. And then on the right there, if you want to connect with me on LinkedIn, you can scan that QR code instead and connect with me there. And then, of course, all the socials, LinkedIn, Instagram, Facebook, Twitter, or X as they call it now. Got to change that logo. So if you want to get a hold of us, if you'd like a second opinion on your portfolio, your investment portfolio, if you'd like a second opinion on your financial plan, retirement plan, if you don't have a financial plan or a retirement plan, even worse, please, by all means, reach out to us. The first step in our process is always a 30-minute intro call. Nobody's asking anybody to become a client. We're just asking questions, getting to know you, sharing our process with you, how we work with our clients, answering any of your questions, and then from there we determine whether or not we want to take any steps forward, which the next step would be setting up a discovery meeting, and that's the first part of a 3-part process that we take our clients through. So very non-threatening. We're just trying to help people out, do a good job, save you from some of the bad advice that's out there. So I will stop, shut up, and move on to our agenda. Today we're going to talk about the U.S. stock market first. Then we're going to get into a little bit about international stocks. We're going to talk about bonds, fixed income investments. Then we're going to talk about commodities and currencies. We'll talk a little bit about digital assets, so cryptocurrencies. And then we'll go over a handful of signals, indicators, seasonality, things like that. And we'll wrap it up with the big picture. So I use the same quote. I always start with a quote of the day. I used the same quote in the Market Outlook presentation earlier this year in January. And it was actually one of 2 quotes, but I usually like to use different quotes because, of course, who likes redundancy and boring? And here, seeing the same quote again, right? That gets boring, but it's just applicable again. I hear a lot of opinions that come into my office. I see a lot of opinions on the internet, social media, and the fact is, John Templeton, he said, bull markets are born on pessimism, they grow on skepticism, mature on optimism, and they die on euphoria. So the question is, where are we right now? And I think that's what we'll answer at the end of this presentation today, as we go through a bunch of charts, tables, indicators, and so on and so forth. But this is how the market works, and I think that we are very much still at a point where that quote applies. And let's jump into looking at U.S. stocks. So first and foremost, let's look at the S&P 500. This is the breakout, right around 4,800 on the S&P. It's been a while now, since early 2024 when this breakout occurred. We saw a pretty, big pullback here in spring as the market pulled back, and we thought maybe it might retest that 4,800 line in the sand, and it didn't. So it pulled back. It did not retest that line in the sand. It headed northward, broke out above that high, so we got a higher high here. Then we have another higher low. This is an uptrend. That's what an uptrend is: higher highs, higher lows. And then right now we kind of have this sideways, choppy movement this last couple weeks, maybe a little bit of indecision. There's some people that might try to draw a wedge here that, in my opinion, would not apply. It's not, it just wouldn't work. So I think that sometimes there's always people out there, I think sometimes, that are trying to find anything they can to suggest the market's going to crash tomorrow, next week, next month. They're looking for anything they can that's pessimistic, doom and gloom. And I'm not sure why that is. I'm not sure if it's because all their money's in cash, so they hope it goes down because they are jealous, maybe, of people making money. I'm not sure if it's maybe they don't have any money and they just like to talk trash in the market. But the fact of the matter is here, we're looking at a very, very unequivocal uptrend in the market. And as the saying goes, you don't fight the trend. The trend is your friend till the end when it bends. So right now it's not even bending. We just saw an all-time high in the S&P 500. So definitely not anything to be super concerned and freaking out about right now. Let's look at the S&P in a different way here. This is an S&P 500 chart with a 200-day moving average and a 50-day moving average. So the 50-day moving average is the average movement of the S&P over 50 days. And of course, this shaded line here, I would call this underwater. I like to use that analogy a lot, but that's the 200-day moving average. So it's more of a long-term trend. It's the average movement of the S&P over 200 days. Now, something I forgot to draw on the chart here, I meant to annotate it, and I did with most of our charts. I annotated most of them, but there was a negative divergence here that was appearing back in between late 2023 and spring of 2024. And you could argue that maybe that negative divergence came to fruition. So in other words, we had lower highs of momentum with higher highs in price, and then price ended up falling after that. Now, it wasn't a big drop. It wasn't even a correction. It was just a pullback, a little heavy pullback, but still, when we look at momentum down here, we can see in RSI, relative strength index, that we didn't even see momentum cross below 30. So we have, granted, a really, really bullish regime would bottom out at 40, but really the line in the sand is 30 here. So we did not see it fall below 30. And then on top of that, this descending trend line here that you can draw with your eyes, with my mouse here as I draw it down, was busted as momentum broke out below that descending trend line. And then again, not only did it break out, but now we have a number printing northward of 70, which is the bullish line above our heads here. So we're still in very much a bullish regime. The market's in an uptrend, trading above a rising 250-day moving average. So all good, all green. Let's look about the value line, the value line geometric index. This is the average stock. And the reason I wanted to pull this up is because it's important to look at your portfolio and know what it is you own. Being diversified isn't good enough. And I want to make sure everybody understands that. And then there is a such thing as being too diversified. In fact, we've had about 5 or 6 new clients come on this year alone that had portfolios with 80, 90, 150 stocks and ETFs in them. I mean, that's just absurd. So what you do when you own that many investments is you essentially just create an index for yourself. You might as well just own the index. So when you look at the value line geometric, we're looking at the average stock. And when you look at the average stock, we haven't even seen the highs that were printed in late 2023. So while we were looking at the S&P a second ago, and I'll go back to that chart real quick here. So the S&P broke out. Actually, this chart's better. So the S&P broke out above its all-time high printed in late 2023, and then headed higher, pulled back, and headed even higher. The value line geometric index, which represents the average stock, hasn't even gotten back to even yet. In fact, you can see these little tops here, 1, 2, 3, 4, 5, 6 tops now, you could say, maybe even 7 if you count this one on the left here in May. But it's having a hard time breaking north of the ceiling of potential overhead resistance, where it just seems that maybe there's a lot of sellers buying that are just kind of selling the average stock here. But anyway, so the average stock isn't so great, which means that you really got to be paying attention to your portfolio, and you have to own good stuff, high relative strength, not just any stuff. Speaking of relative strength, this is the small cap index, so the Russell 2000. So this is the smallest companies, or not the smallest. Micro caps would be smaller than small caps, but this is an index. Basically, it's a basket of some of the smallest companies in the entire investable index and investable market. So what we have here, and the reason I drew this, and it's not the prettiest smiley face in the world here, but we've got some symmetry. It's taken a really, really long time. We have not seen small caps close in on its all-time highs, but we've had a lot of sideways chop. Then we saw kind of a breakout here. Then this high here in March, April tied the high roughly in March of 2022. Pulled back, and now we're just kind of chopping sideways. We could even draw a triangle. I'm not going to do that, but we could draw a triangle right here and say that maybe this thing is just kind of coiling up. The question is, does it head higher or does it head lower? and a lot of that's going to have to do with what the overall market does, the stock market in general, so the S&P, whether it can pull up these small cap stocks, so to speak. And another big part of it's going to be interest rates. So if interest rates go down, that is going to help smaller companies. And I think we all know that at some point here, we don't know when Jerome Powell is going to start lowering rates, but at some point he's going to probably start lowering rates. And when that happens, that could help put some tailwind behind small caps as well. But at the end of the day, as long as this thing stays in an uptrend, as long as it stays above the floor of support that we've got below our feet right now, which is not shown on this chart, then I think small caps are still, a relatively good investment to own. Then we have some relatives. So the relative chart here, this is discretionaries versus staples. This is a chart that I like to use to determine whether or not the market's on offense or defense. And by the way, there's no such thing as an on-off switch. You can't just pick one chart and say the market's on offense because of this one chart. I think it's best to have several indicators, several charts, take more of a weight of the evidence approach to the markets. At least that's what I do. That's what I started doing when I learned from all my mentors. So don't just pick one chart and use one chart alone. I think it's important to look at a bunch of different things and kind of, again, take a weight of the evidence approach. So as you can see here, going back to 2021, generally speaking, we've got an uptrend here, this moving average. I believe it's a 150-day moving average, going up into and when this goes up, that means that discretionaries are doing better, meaning luxury goods, things that people want to spend money on. And the opposite, staples, these are things that people need to spend money on. Think razors, food, things like that. So you can see here in November of 2021, the market started to roll over, if you remember. But then you can see, but as this was happening, we started to see consumer staples outperform the discretionaries. So when this chart goes down and crosses below the 150-day moving average, and then you see that moving average start to slope downward, that indicates that staples are the better investment. They're stronger than the things we want. So in other words, when you start to see more strength in the investments that we need, or the companies we need to buy from, as opposed to those that are fun that we want, then the needs and wants equation starts to change here, and all of a sudden we find ourselves in bad shape in the market. So since pretty much call it May-ish, I'm going to say May-ish, heavy on the ish, we've seen pretty much a positive trend here in consumer staples. So we'll call it May of 2023. Since then, we saw a little dip here. In fact, earlier this year in spring, there was a lot of chatter about, is there going to be a rotation out of high beta stocks? Is there going to be a rotation out of growth? Are people, investors, switching over to utilities because they're nervous about a crash? So there was a lot of chatter out there, and what I found interesting was that while this did show, or at least we see the chart goes below the moving average, it tries to get above it and it can't, it falls back below. That would usually be an indication that this thing's going to hold, and that maybe staples were going to become the stronger investment, and thus the defensive market action might have been warranted. But what I found interesting is in our portfolios, when we looked at our clients' portfolios and all the different model portfolios we manage, the individual stocks within those portfolios were not breaking down. So in other words, when the way we manage portfolios at our office is we're buying the strongest, so on a relative strength basis, the strongest stocks within the strongest sectors, within the strongest industry groups, within the strongest asset classes, until any of those things change. And if those things change over time, it's like shifting a stick shift car. You got to put the clutch in, the car slows down for a second, you put it in a new gear, and then you can kind of head off to the races. But when you're in a downtrend, it's like going in reverse. So what was happening back then in spring this year was that we just weren't seeing many stocks get sold. So the highest relative strength stocks were still performing just fine, even though there was all this chatter about things we need. So the needs versus wants chart was pointing towards needs, which indicated, again, defensive action. But it turned out it wasn't that big of a deal after all, and we saw this rotate right back out again. So pretty interesting. This is a similar, I won't spend as much time on it, but this is the technology versus utilities chart. So if it's going up, again, technology is the better performer, or in other words, the highest relative strength investment relative to utilities. And as soon as you start to see it cross below this 150-day moving average and trending down, here between 2022 and 2023, we saw utilities as the stronger investment of the two. Now, since 2023, with, again, the exception of this past spring, when there was, again, all that chatter and people worrying about market rotation and potential crash, It was very, very short-lived, but otherwise we've seen technology and control with utilities taking a back seat. And then, by the way, the reason why this is a good chart to look at from a relative strength standpoint is because utilities are typically more blue chip stocks. They pay a high dividend. High dividends mean safety, more defensive investments, whereas technology stocks don't tend to pay a dividend. They tend to be higher growth, higher flying stocks, but they can also sink like a rock as well. So when things aren't going well in technology, they're not going well. But when things aren't going well in utilities, it doesn't hurt as bad, and you've got a dividend, which is why this chart makes a lot of sense. All right, moving on. Let's change gears, talk about international stocks. I've only got a couple charts here because international stocks aren't really, don't get me wrong, there are regions around the world that are doing well. But overall, when you look at the overall international markets, this is the All Country World Index, ex-US, meaning all countries overseas, not in the US. And you can see here that it's got another 11% to go before it even hits its all-time high, whereas the S&P 500 hit its all-time high and surpassed it earlier this year, as I mentioned. So right now, while we do have an uptrend here in large caps, when you think of it from a ranking standpoint, S&P, NASDAQ, domestic stocks, Dow, still better than international markets. And if you don't believe the chart, and if you don't believe me, then all we have to do is pull up a relative chart here, and this is just like the other ones. So this is a chart that compares the S&P 500 versus the ACWI. And when this chart is going up, and when the line is above the moving average and the moving average is sloping up, that means the U.S. is outperforming international stocks. When it goes down, and there was a time in between late 2022 and call it halfway through 2023, where we were allocated a little bit and then a little bit more to international stocks because we started to see international outperform the U.S. for the first time, steadily for the first time since pretty much 2009. But again, it only lasted about 6 months or so, maybe a little bit longer, and then all of a sudden we saw U.S. as the better performer. And right now, again, easily, my fifth grader could tell you which is the better investment here, U.S. versus international. So not a whole lot else to talk about when it comes to the international markets. Let's talk about bonds and fixed income. There's been a lot. It's so funny because I've been doing this for almost 23 years now, and I spent the first 20 years of my career having nothing to really say about bonds. Fixed income was pretty much boring. Nobody bought bonds. Interest rates were horribly low. It was just, you had bonds in your portfolio as a steady allocation to help reduce volatility, to help create, call it, the drink that makes your meal go down easy, as opposed to the stocks and, in the U.S., international stocks that were like your meat and potatoes, and then your commodities were like your jalapenos. Of course, when people put commodities on the portfolio and jalapenos, everybody freaks out, but I digress. But point is that, every time we talk about bonds, it's like, okay, bonds are still going up, not a whole lot, but they're going up a little, and that was kind of what we talk about every single time, but not anymore. This has been just, I've talked about this now for 2.5, almost 3 years, but since COVID, bonds have been decimated and rates have been going up. That is not a secret. Everybody knows that, even if they don't know what it means. And you can see here when you look at the 10-year note, the 10-year yield. So this is not bonds. This is the 10-year interest rate. We are sitting right now at rates that we were at back in 1998. 1998. So, you could also follow this red line forward and see that we had similar rates in the early 2000s. We had similar rates here in the mid to late 2000s, and then rates kind of just kept steadily going down until they bottomed out during COVID. And now they've risen, and not just slowly, they've risen pretty fast. And now I don't know if they're going to head lower right away. Like I said, Jerome Powell has to decide that he's going to start lowering rates before we start to see this chart, I think, make any material changes. But the 10-year note, this is the 10-year Treasury yield, is probably the closest thing to look at if you're interested in knowing what mortgage rates are doing. The 10-year is the best thing to look at. And then this is the 30-year. The 30-year note is 30-year Treasury yields. So this thing's up 400%. And the only way to get that kind of return would have been to short bonds, literally when they went limit up during COVID, and then to hold that position the entire time until then. And it obviously wouldn't be exactly the same because this is the 10-year note and we're talking about bonds now. But you can't own the yield and make money on the yield in an ETF. So, but anyway, so this is bonds though. This is the 30-year bonds. This is spot bonds, so Treasuries down 37% since they went limit up during COVID. But you can't invest this way. The only way to, well, not the only way, but the main way that we invest in bonds, it would be through an ETF. TLT is the U.S. Treasury bond ETF for 20-year treasuries. And since COVID went limit up on bonds back then, it's down 47%. So bonds are, TLT, Treasury bonds, are worth almost half what they were just 4 years ago, which is pretty incredible when you think about it. We're always taught, our whole lives we were taught, and our parents were taught, and for those of us who still have grandparents that are alive, our grandparents were taught, buy bonds in your portfolio. The older you get, the more conservative you get. The older you get, the more conservative you get, the more bonds you should have in your portfolio. And then all of a sudden we see bonds just get, like I said, vaporized over the course of this last 3 to 4 years because interest rates have been going up and nobody was doing anything about it. It was really kind of frustrating me. You look at corporate bonds, it's not all that different, down 33.4% since the COVID highs. So no bueno. So what now, right? I guess that's the question is, when is it going to be a good time to buy bonds again? And, here's shorter term. So this is 7 to 10-year treasury bonds. And the shorter you are on the yield curve, the shorter the maturities, the less it hurts. In other words, the less pain you feel when things go down, but obviously the less money you make when they go up. But down 25% almost, 7 to 10-year treasuries. But when's going to be a good time to buy bonds? I mean, I don't know, other than the fact that I'm watching the Fed and I'm watching these charts all the time. And what I'm looking for is higher highs and higher lows. I'm looking for a move above, 50, 150, 200-day moving averages. I'm looking for those moving averages to start sloping up. And I'm looking for these bonds to prove themselves. I'm not trying, nor do I ever try, to pick the bottom. One of my mentors years ago, he told me that only monkeys pick their bottoms. So I'm not a monkey anyway, and hopefully you're not either. But bottom line, we don't want to try and catch a falling knife. We don't want to try and guess the bottom. And as my good friend Dave Keller says, never ever confuse the bottom of the chart with support because it can go a whole lot lower. The bottom of this chart says 87. It can go a lot lower. So do I think it's going to go a lot lower? I don't think so. I think that interest rates are probably not going to go up from here. I think they are going to go down. The question is when, and we don't know. So I would say pay attention to the charts, pay attention to the Fed, and just kind of go from there. Now, just one last thing about bonds. When we compare the U.S. stock market to the bond market, very easily you can look and see that stock's the place to be. There was a time period here between 2009, call it late 18, 2019, all of 2019, where it was really, really choppy. It was a good maybe to have both bonds and stocks in your portfolio because there was a lot of indecision. Then COVID hit. Bonds did a whole lot better. We had literally our best bond trade ever, and at that point, 20 years of our company being in existence during COVID. And but since then, stocks have been the place to be. So this chart's going up. That means stocks are the better investments. That means that bonds are not. So one last thing I want to share. This is it's funny because for years and years and years, I've never been well, let's put it this way. I did a podcast a couple years ago, maybe 3 years ago at this point, almost, and the title of the podcast on YouTube, you can look it up and find it on our Libertas YouTube page. It's titled "Why Annuities Suck and When They Make Sense," or in what situations they make sense. So the point is, I've generally been somebody who didn't really like annuities a whole lot as this market's been, going up over the last several years or up until COVID. But now that interest rates, more importantly, interest rates have gone up so much, all of a sudden, fixed annuities, indexed annuities with fixed components, equity fixed indexed hybrid annuities, they're starting to look attractive all of a sudden. And now I'm not so sure that I would use them as your the equity position in your portfolio, in other words, the stock position, just because there is a tie here to the S&P 500, which is obviously a stock market index. And I also definitely would not just put all my money into something like this because that's obviously, I talked about you can be over-diversified pretty easily. That would be pretty under-diversified, not to mention there's penalties. You can take withdrawals out of these without penalties up to 10% per year, but there are penalties to get out if you wanted more than 10% of your money. So as part of a diversified portfolio that makes a lot of sense based on your tolerance for risk and most importantly, based on the output of your financial plan, your retirement plan, these fixed annuities are starting to look very interesting. This one I've got up here is from Lincoln. Right now, I'm just going to look at for any investment over $100,000. The fixed guaranteed bucket is paying 5.45, which means this thing does not go down in value ever. It only goes up, and the fixed bucket's 5.45. The bottom there, the 1 year S&P cap, basically it's 1 year point to point. If the S&P's up 5, you get 5. If it's up 8, you get 8. If it's up 15, you get 9.75 because that's the cap. The performance trigger and the dual trigger are a little bit more complicated, so I'm not going to talk about those two. I don't have time today, but if you have questions about these and have interest in learning more to find out whether or not it might make sense as a piece of your portfolio, specifically maybe a piece of your bond portfolio, a portion of your portfolio, because I just got done talking about how horrible bonds have been. So since bonds have been so horrible, this has been a great place for some of the fixed income or bond allocation of your portfolio. And if you're a really, really, really conservative investor, it might make sense for someone to call it your equity income portion of your portfolio, especially in a world where, there's not, dividend investing isn't something I personally believe in. So, but that's another screencast for another day. So anyway, we're moving on. Commodities and currencies. I'm going to fly through these real quick. This is the commodity market overall. Pretty easy to see we're in a kind of a long-term downtrend that keeps trying to get back above water, but just can't seem to do it. We catch my breath, go underwater. Catch my breath, go underwater. Right here, just follow my mouse. Above water, underwater. Above water, underwater. Above water, and we'll see what happens here. But we've got a descending 200-day moving average and a descending 50-day moving average. So not so good overall when you look at commodities as a whole. What is interesting, though, is when you look at 2022, go all the way to the left side of the chart. For those of you that are clients of ours, you'll know, or maybe you'll remember, that most of our portfolio, or the highest percentage of the investments we owned back then, were mostly energy stocks. We owned some oil, we owned some gold. So 2022, bonds were tanking, stocks were tanking. There was almost nowhere to hide. The only thing making money was energy and commodities. So as you can see, that's how things were back then. But again, as the world changes, so does the market. And since then, we've pretty much seen a downtrend in commodities. But when you dig down and underneath the surface, you can find some things that maybe look a little bit better. And this is not commodities. We're looking at currencies here. This is the U.S. dollar. And by the way, all this talk about inflation, not to split hairs, but when people talk about inflation, understand the definition of inflation is the devaluation of a currency. And the reason why inflation happens when currencies get devaluated is because when the value of a dollar or any country's currency goes down, it takes more of that currency to buy the same stuff. So if the dollar were to go down in value, it takes more dollars to buy the same thing, which is why inflation goes up. We have not really seen inflation in terms of currency devaluation. What we've seen is inflation just due to supply and demand imbalances, meaning less supply and the same or higher demand for the same products, which has caused prices to go up. I don't want to say when, but if we started to see the U.S. dollar fall, that would not only cause more inflation, but with the supply and demand imbalance trying to work itself out right now, it would obviously add fuel to fire, or at least rekindle that fire with some more fuel and some more wood that we don't want. So paying attention to the U.S. dollar is definitely something that's advisable as you look at your portfolio. And then the other thing is when you start talking about the economy, and some people say, oh, the U.S. has so much debt, and it's like, that's true, but we're still the cleanest dirty laundry. And as long as on a relative basis, we are still the best country, the strongest country in the world, then I think that's going to fare well for us. Not farewell, but fare well. But yeah, anyway, I digress. Let's talk about oil. Oil, again, did well in 2021, 22, but since then, just kind of sagging. We've seen this maybe the start of a smiley face here, start of some symmetry perhaps, but lower highs and then higher lows. That's a triangle pattern. If you drew a line with my mouse here, so top of the line is here, bottom of the line is here. Maybe we got a triangle. Now the question is whether or not it's going to break out or break down. Breakouts tend to happen in the direction of the prior trend. Prior trend is down, so my imagination, I imagine things would probably break down, but there's also seasonality involved here. So as we start to see travel season pick up, that can add some demand to oil and so on and so forth, as well as in the winter months, it can add some demand as well. So I guess there's always demand everywhere in some way, shape, or form, but it's all about the bulls and the bears and who's winning, right? And the only way to tell that's by looking at a chart. And speaking of bulls and bears and who's winning, here's a chart of gold. This is GLD, the ETF. We've got gold breaking out above all-time highs for the first time in years. It's taken forever for gold to break out. It's tried so many times and failed. Finally, it broke out. Now we've got all this profit. So we've got the breakout. We've got a tiny little consolidation, another breakout, measured move, almost perfect. I mean, when you look at the distance between the bottom here at about 184 and 202, and then the bottom here at about 200, and then peaking out at 222-ish, I mean, that is a measured move if I've ever seen one. Now what we have is we have a rectangle. We have a trading band, basically. It's this thing's bouncing back and forth. It's kind of leaning on the bottom side here of this trading band, but we've got a rising 200-day moving average. We've got a 50-day moving average that's curling down, but not that big of a deal. That's a very, very intermediate trend. So right now I'm looking at this thing, as long as we don't break below, call it 211 or so on GLD, and this thing stays in this rectangle, this range, then it would be it would be likely that this breaks out, not breaks down. But obviously anything can happen, so that's why we look at the charts. That's gold. Now we're looking at silver. Silver's a little choppier, not as much volume. Silver has broken out here. You can see higher highs, higher lows, so definitely an uptrend. Also consolidating, but not so much sideways, more like consolidating down, more of a pullback. So, but silver looks good as well. This is gasoline. Gasoline, I went back to COVID again. I feel like I'm always running things since COVID. But since COVID, we saw gasoline prices tank. There was a point at which you would, gasoline prices were literally negative. So if you own futures contracts or contracts in gasoline and you didn't cover, you could end up with a bunch of gasoline in your driveway. But we have, since then, a pretty big uptrend. Now it's been kind of chopping sideways since, call it mid 2022, but gasoline prices have gone up quite a bit, and then they've kind of flattened out and stayed the same, and we aren't really seeing the same kind of decline in gas prices that we're seeing in oil. So, and then on a relative basis, again, which is better, U.S. stocks or commodities? Pretty obvious. So again, here we are in 2021. Commodities start looking a lot better than U.S. stocks. Through 2022, that accelerates. And then ever since late 2022, early 23, we've seen U.S. stocks as the winner, the leader, with the exception of fall-ish of 2023. So again, back to U.S. stocks being the place to be. Let's talk about digital assets real quick. I got to move quicker here because I'm literally running out of time. But we have Bitcoin. Bitcoin's kind of sitting here right in these tops. If you draw a line with your eyes across the top of these tops here, it's technically below this all-time high on the left. And then you've got a rising 200-day moving average and a flat 50-day moving average. What this looks like to me is it looks like the Bitcoin market is just consolidating and digesting the gains that we saw since late 2022. So there was a halving recently. That halving has a tendency to precede big moves. We're watching this very closely to potentially add it to our clients' portfolios, looking for a good entry point. But right now, again, we got to make sure it proves itself as well. We don't want to, sit here and buy at the top and get killed right out of the gate. Not to mention, when you look at the investment, let me go back. Sorry. When you look at the investments you can buy, there's the Grayscale Trust, which is a little bit riskier, less regulated. There can be some issues with trading, so you got to be careful there. The ETF BITO, I would say is the more regulated, safer ETF that came out more recently. Better investment to own. Problem is there's issues with contango, backwardation, because it follows the futures market and not actual Bitcoin holdings. And since it follows the futures market, there can be other issues that affect the stock. So there's pros and cons to each. But right now, Bitcoin is holding up better than BITO, which is good because it indicates that perhaps maybe it could create even better buying opportunity. But we're going to have to see. Ethereum looks a lot very similar to Bitcoin. The difference is that it has not gotten back above those all-time highs on the left there. So it almost looks a lot like, not literally looks a lot like, but it almost reminds me a lot of gold and silver. So gold's doing better than silver. Bitcoin's doing better than Ethereum. In fact, if we look at a relative chart comparing the S&P 500 stocks to BITO, again, that's BITO. Actually, no, I did Bitcoin in US dollar, my fault. No, I didn't. I'm sorry. This is labeled wrong. I remember specifically using BITO. I just didn't update the header, so my apologies. But this is BITO. Oh, yep, there we go, right there in the middle there, behind the chart. So the watermark. So the watermark, this is the S&P versus BO. If it's going up, that means the S&P is better. If it's going down, that means Bitcoin is better, the Bitcoin ETF. And right now we're seeing the U.S. start to perform better after Bitcoin was outperforming for a while. So we're just going to have to wait for this to get better again, wait for Bitcoin to prove itself and find ourselves a good entry point. Let's talk about some signals, indicators, big picture stuff, seasonality. First and foremost, I know that there's been a lot of people talking about deteriorating breadth, not breath, like breath coming out of your mouth, but breadth. So participation in the market. When the market's going up, you want to see a lot of stocks participating. So the in the upper pane here, we've got the S&P, and then the bottom pane, we've got the percentage of stocks trading above their 200-day moving average or their 200-day trend line. So right now you can see that while the stock market's been going up, we have fewer and fewer stocks trading above their 200-day trend line, which means that there are less and less stocks participating in this uptrend, which is not good. But that doesn't mean that you should run for the fences and freak out, because we're still talking right now at this moment in time about 64% of stocks are above their 200-day moving average, which is not only a majority, but it's above a bullish line of 60 that I like to watch. In fact, I don't really get too concerned until it crosses 50 and 40. Those often end up being buying opportunities. 40 is really a line in the sand where it's like, time to I don't want to say run for the fences, but time to really look at your portfolio. If you're not looking at it enough, you're probably too late at that point to really catch a lot of the worst positions. But anyway, I digress again. I'm going off the rails here. This is the percentage of stocks with momentum above 70. I find this really interesting. So only 2% of stocks have a momentum above 70. RSI above 70. So what that means is that we have a lot of stocks that have pulled back in momentum, not just price. And then this is the percentage of stocks with RSI below 30, and there's only 5. So this is bearish regime, only 5%, and bullish regime, only 2%. So what this is telling me is that it's kind of a point of indecision, a point of consolidation, digestion. It's a pause. It's the market can't go straight up. In fact, we wouldn't have a job if that were the case. So the market breathes. It goes up, it goes down, it goes up, and it goes down. So as the saying goes, the market goes up the escalator and down the elevator. So sometimes that happens during market crashes. But so far, when I look at breadth indicators, have they been deteriorating? Yeah, but deteriorating maybe comes along with a really, really negative connotation that sounds maybe worse than it is. And I don't think the market is as bad as some of the words that are being used out there. Let's talk about seasonality. We're in the middle of an election year here. We are in, this is a little bit old, just about a couple weeks old here. But in 2024, we've had a great market. Again, market goes up, pulls back starting in April, and then heads back northward again. The question is, this is Jack Hirsch, Almanac Trader, or Stock Trader's Almanac. Are we set for a mean reversion? Because this chart right here, this line in the sand, is the average stock market movement on the S&P 500 when we have a sitting president running for re-election like we do this year. Biden's running for re-election, so the line we're looking at is this one right here. Market tends to go up for the first month and a half, pull back until almost the end of April. Then it tends to just kind of go up the rest of the year pretty steadily. This year, again, was different. Market goes up a lot more through the first 1, 2, 3 months of the year, pulls back for a month, and then it's had higher pretty much since then, and now we're just chopping sideways. So one of the two things happen. The market corrects through price, or it corrects through sideways chop, through digestion. Price would mean that the market correcting downward. If it corrects sideways through chop and digestion, that just means it just kind of chops sideways while this average catches up. Because at the end of the day, these are just averages. This line right here is a line of linear regression based on a bunch of other years, a bunch of other election years where there was a sitting president running for re-election, which means there are years when it was better and there's years when it was lower. So this could just be one of the years that's better than others and ends up bringing this average up next time. So just keep that in mind as well, as opposed to being so bearish. Real quick, this is Sentiment Trader's risk on-off indicator. There's a bunch of indicators that go into making this indicator, so think of it like a combo indicator of a bunch of indicators into one, and this has been pretty much in risk on with no line below 50 since pretty much late 2023, and that's, well, yeah, that shouldn't be surprising to most people. This is Lowry Research's buying power versus selling pressure index. We have seen, what we want to see is we want to see selling pressure below buying power, and we want to see it trending down. We want to see buying power above selling pressure and see it trending up. Most recently, we saw a cross of selling pressure above buying power, and now we see it kind of hooking are curling over on both sides, up and down. So again, this tells me, again, there's more indecision out there. So not a reason to run for the fences, but indecision. Now, what gives me more bullish, positive feelings? This right here. The ESPN Fear Greed Index, it actually surprised me to see that there were so many people that are fearful. The market's not doing that bad, but we have a fear greed index that's already into the fear category. So, I mean, I'm happy. I'm good. I'm glad that that's the case because, in fact, if we can get people freaked out and all the way down here into this extreme fear category, then that just means that the market's primed for potentially a good opportunity to buy more stocks, get involved in the market more, and chances are, not only does this tend to revert to the mean, but when this is at extremes, when we start seeing fear and greed at extreme bearishness, then the market has a tendency to do better. Furthermore, of course, when we see fear and greed and extreme greed, then that's when we tend to see the market pull back or even correct at times. And this is, again, Sentiment Trader. This is their smart money versus dumb money confidence index. And I just drew vertical black dotted lines. So the black dotted lines are mine. Whenever we saw peaks above 0.7 in this index, and you can see here that whenever you've seen these peaks, they tend to be at or near tops. And this one way back in 2021 kind of preceded a sideways choppy area, a little breakout, and then a fall. Obviously into 2022. Here's a peak in 2022 and it fell again. Here's a peak in 2023, it fell again. And here we saw correction again. Here this was just a little bit of sideways movement and it's gone up since then. But what I've also found really interesting was that we're seeing a declining highs in this dumb money index, and I don't know that it necessarily makes sense to use this index like that, like a divergence per se. But I do think it's interesting that as the market's been going up, we've seen less and less peaks or less high peaks in dumb money confidence, because what we want here is we want to see the market obviously going up, and when we see these peak out at really, really high levels, that tends to precede corrections or sideways consolidation. What else do I got? All right, big picture, long-term asset class ranking, big picture, 30,000-foot view. U.S. stocks are number 1. International stocks are number 2. Small caps are number 3, but just barely behind them are money markets, short-term money markets, T-bills. In the basement down here is commodities, and even worse, or the worst, would be 20-year treasuries, so long-term bonds, no bueno. Looking at things from point and figure standpoint, so this is NASDAQ Dorsey Wright. This is looking at point and figure charts. What this does is it takes all the time out of the equation. So in other words, when these charts are compared to one another, there is no time used at all. It's just simply price movement, and that's it. So it's just another way to slice and dice momentum and ranking. And right now what we see here is a little bit different picture versus the prior ranking I just showed you. This has domestic stocks at number 1 again, so that's the same. But it has commodities at number 2 on a point and figure basis, price movement only, international stocks at number 3, then money market T-bills at number 4, currencies, foreign currencies at 5, and then bonds in the basement. So the bonds are also in the basement on this chart or table. U.S. stocks are also in the pole position, but the stuff in the middle is a little bit different here. So again, weight of the evidence. Just remind yourself, weight of the evidence. Looking for signs here, hints, clues. I've got my inverse traffic light chart here that we put up, and this changes all the time. As the market changes, the zones change. So what we have right now is the market sitting in the green zone, which resides above the pivot high from spring. We had that pullback in the market, a breakout, higher high, a pull out to the prior line of resistance, which then became support, and then the market headed higher from there. The green zone is anywhere above this high and this low right there. That's where our caution level, our yellow caution zone starts, which bottoms at the highs from July or summer of 2023 and the highs of spring of 2022. So that's where our caution zone ends. Anywhere below that, probabilities are very high that our tactical trend following models would be selling a lot of stocks by then, and we would be pretty cash heavy. Just to close up here, a couple final thoughts. Again, looking at the market from a weight of the evidence standpoint, looking at what things look like right now. This pre-flight checklist is a concept that I I'll use an eloquent and say borrowed, so eloquent word there. I borrowed the concept and the name from Dave Keller. I just thought it was a really cool way. Whenever you get in a plane, you always have to check a bunch of stuff, go through a list, and see what's going on before you even taxi out to the runway. So the pre-flight checklist is what we look at here at our office before we start each day, essentially. And what this tells us is on the S&P and the NASDAQ on the left here, it tells us what the short-term trends are. It tells us what the tells us what the intermediate term trend is, the long-term trend, then market climate on the right there, looking at S&P, the Qs, so NASDAQ 100 as well as small caps, and then whether it's safe for new entries into the market. And what we're looking for here, I'm colorblind, so I have everything custom coded here, so it's blue and red as opposed to green and red, with the exception of these two columns right here. But we want this to be mostly blue for the most part, and then for it to be green when we look at those two columns. And that's what we're seeing. So, things still look very bullish. And while I do think the market's very healthy right now, I do think that anything can happen. Of course, we can see a pullback. We can see the market chop sideways. We could see a correction. Any of those things are possible. If Biden were to step out of the race, I think that would definitely cause some market volatility and a potential pullback, honestly, if not a correction in the markets, because the markets hate uncertainty, and they definitely wouldn't like not knowing who's going to run for president on the Democratic side. And it would also create a whole new box of variables that, Pandora's box gets opened up when that happens. But at least for now, things look really, really good. But you always have to be prepared, because the gain you need to make up for a loss is always a whole lot more than the loss itself. So if you lose 10%, you need to make 11% to get back to even. If you lose 20, you got to make 25 to get back to even. If you lose 30, you got to make 43%, and so on and so forth. If you lose 50% of your portfolio's value, your retirement portfolio, you have to make 100% just to break even. And heaven forbid you're taking money out of the portfolio on a monthly basis. In other words, there's a hole at the bottom of the boat. It's not a bad hole. It's what it's for. Your money is for you to spend. I want to make that clear. But when you're spending your money and you're retired, it is that much more important to be careful, pay very close attention to your portfolio, and make sure that you've got a finger to the pulse of the market on a day-to-day basis, or a professional who knows what they're doing and is doing that for you. So with that all being said, thank you so much for watching today. Again, this is how you get a hold of us. If you have a second opinion on your retirement plan or portfolio, your investment portfolio, check out this QR code here, or you can email us at info@libertaswealth.com, or you can just go to our website at libertaswealth.com, and there's plenty of buttons to click to find out if you're a good fit for us. If you want to connect with me on LinkedIn, I'm right over here on the right. Same thing with Twitter, Facebook, Instagram, and I'm actually on TikTok as well now, believe it or not. I tried so hard not to do it, and I folded, I guess. We'll call it. So that's all I got today, everybody. Thank you so much for watching. Hope you learned something, and we will talk to you soon.